All right, today we are going to do the consolidated statement of profit or loss and other comprehensive income. And this is, the consolidated income statement. So, consolidated income statement. The first thing you need to know when you're preparing the income statement is the mid-year acquisition. Remember one thing, that when you are making the income statement, you need to see when the subsidiary is acquired. If the subsidiary is acquired mid-year, then the complete operation of the subsidiary from the revenue till the profit for the year will be prorated. Prorated means that we are going to take only those months which comes in this year. Like say, for example, if the year starts at 1st January and ends at 31st December and the subsidiary is acquired on 1st March, then 9 months will be consolidated. If it is acquired on 1st October, then 3 months will be consolidated. So only you need to consolidate those months which comes in this year. So if you see this income statement, the principle remains the same, that we will be consolidating on line by line basis, but now it's the income statement. So parent sale with the subsidiary sales, parent cost of sales with the subsidiary cost of sales, similarly parent gross profit plus subsidiaries gross profit, and all those things. So the second thing is, again, you are going to remove the intra-group transaction. When you were talking about the balance sheet, you were actually eliminating the intra-group balances. Here it will be intra-group sales and intra-group purchases. The first thing. The second thing is here it will be the depreciation as well. The fair value depreciation will be allocated. Here you will be removing the unrealized profit as well. Here, if the parent or the subsidiary has given loan to each other and they are charging interest to each other, those interest payments will be eliminated as well. Similarly, if the parent or the subsidiary are giving dividend to each other, that intra-group dividend will be eliminated as well. So these are the few things you need to know. The first thing, if you see, is the revenue. So we are going to take the revenue of the parent plus the revenue of the subsidiary, and you're going to see that I am going to prorate the subsidiary by months by 12. So if there are 4 months, or take 4 months, if 5, then 5. So parent will be the complete consolidation plus subsidiary months by 12 minus intra-group sale. This is the sales made by parent to subsidiary or subsidiary to the parent. We will be removing that on consolidation. Then you have the cost of sales. So cost of sale of the parent plus subsidiary, again months by 12, minus intra-group purchases, because when you sell, then in one company there will be a sale recorded, in the other company there will be the purchases. So sales and purchases. So intra-group sales and intra-group purchases, right? Intra-group sales will be removed from the sales and intra-group purchases will be removed from the cost of sales. And then you have the unrealized profit. I said that we need to eliminate the unrealized profit. So why we are adding it? Because if you remember the formula of the cost of sale, the cost of sale is opening inventory plus purchases minus closing inventory. This is the formula of the cost of sale. So if you need, obviously this intra-group profit, which is unrealized profit, is present in this cost of sales here in closing inventory. So if you want to remove something from the closing inventory, then if you are adding it, then that will be removed. If you are actually applying the minus sign, then it will be automatically added to the closing inventory. So we are just removing the unrealized profit from the closing inventory, and that means you need to add it back to the cost of sale. The fair value depreciation, because normally the depreciation is allocated to the cost of sale as per the new guidelines provided by the IS1. It can be charged to the cost of sale, administrative, and distribution, and you will not see the cost depreciation figure as a separate head in the income statement with the new IAS1 format. So this fair value depreciation will be allocated to the cost of sale probably in the F7. If they have said that allocate it to the administrative expenses, then you can allocate it over there. So once you calculate the revenue and cost of sale, then GP will be automatically calculated. Then you need to take distribution cost, parent, again plus subsidiary, months by 12, administrative expenses, parent plus subsidiary, months by 12. Then you have investment income. Investment income of the parent as per statement of profit or loss plus subsidiary minus intragroup interest and minus intragroup dividend. Remember one thing, that if the parent or the subsidiary are giving loan to each other, so for one company it will be a finance cost because they are taking the loan, and for the other company it will be an investment income because they are giving the loan. So for one company it will be the income, and for the other company it will be the cost. So we'll be removing the both. We'll be removing the intragroup interest from the investment income, and we will be removing the intragroup interest from the finance cost as well, because for one company it's income and for the other company it's the finance cost. Similarly, if the parent of the subsidiary, probably subsidiary has given the dividend to the parent, it will be removed on consolidation as well. So finance cost, if you see, the parent plus subsidiary plus unwinding, if you remember the unwinding which we made on the contingent on the deferred consideration, it was the finance cost, it will be added over here, and then minus intragroup interest. Then you have the impairment of goodwill, which is coming from the working number 3. It will be deducted from here. And then you have the share of profit from associate. Share of profit from associate is something which we studied in the balance sheet as well, that when the parent has acquired 20 to 50% share of the company, that it is an associate. In the balance sheet, the cost of investment in the associated will be recorded, and in the income statement, share of profit from associate will be recorded. Then you have the profit before tax, then you have the income tax expense, then this is profit for the year. So now the next step is that you have the other comprehensive income, which contains the gain or loss on fair value through other comprehensive investments and gain or loss on revaluation, and then it gives you the total comprehensive income for the year. Now the other important thing is this portion. This is actually the distribution. This is actually the distribution. What is distribution? Now, the profit you have calculated is shown separately on the face of the profit or loss. That is profit attributable to, that means we are distributing it to the parent and the NCI. We are distributing it. Similarly, the total comprehensive income of the parent and the NCI. But in order to distribute this profit, in order to allocate this profit, you need to do a separate working, because most of the students make this mistake, that they take this figure, which is profit for the year, and they distribute it between the parent and the NCI. This is the wrong treatment, technically wrong, obviously, because the NCI should be given the share from the subsidiary's profit rather than the parent's profit. So this profit for the year is actually the parent plus subsidiary. And in the NCI, we need to allocate the profit only from the subsidiary. So what we're going to do, we will be actually calculating that. So the calculation is shown on the other page, but here I will be showing you that how you can calculate the NCI distribution. You take the subsidiary's profit for the year, you multiply it by months by 12, you multiply it by NCI percentage, and it gives you the profit which belongs to the NCI. This is simple, but there are some adjustments which you need to incorporate. 3 adjustments. First one is the unrealized profit. Second one is the fair value depreciation. The third one is the impairment. Okay, these 3 things, the unrealized profit if the subsidiary has sold to the parent, the fair value depreciation of the subsidiary, and the impairment of the goodwill of the subsidiary. So you will be taking these figures the total figures, and you will be multiplying it by NCI percentage, and these figure will be deducted from here. Now this is the profit which should be distributed to the non-controlling interest. So remember one thing, don't make the mistake in the exam by distributing the profit for the year between the parent and NCI, because we need to distribute to the NCI the profit of the subsidiary rather than, and you need to allocate some adjustments as well. So once you have calculated this NCI profit, you will be taking this profit over here. Okay, this is the working which you have done, the static one. And now if you compare this profit for the year which has been calculated with this NCI, the remaining profit, if you take total profit for the year and you just deduct the NCI profit which you have calculated from the working, the remaining profit, which is the balancing figure, belongs to the parent. So in one step, you have calculated the NCI profit. In the second step, you take the profit for the year and you deduct the NCI profit. The remaining all the profit belongs to the parent. Similarly, if you take the total comprehensive income, okay, this one, this figure, and you deduct the NCI share from it, the rest of the thing will be of the parent. So this is the thing you need to remember. This was the income statement. Okay, the main principles you need to remember is, first of all, the mid-year acquisition. Then you need to remove the intragroup sales and purchases. You need to remove the unrealized profit. You need to remove the intragroup interest, intragroup dividend. But although obviously all these things will not be tested in a single question, there will be some things out of it. And once you are done till the profit for the year and the other comprehensive income, the next stage is the distribution. For distribution, you need to do a separate working. And once you are done with the separate working, then you will be comparing this NCI profit with the profit for the year, and the balancing figure goes to the parent. So this is it. This is how you calculate the things. This was the income statement. Now we are coming towards the associate. Okay, associate is something which we have 20 to 50% shareholding. Okay, we have 20 to 50% shareholding, and we are required to do the equity accounting. Equity accounting means that one figure will be recorded in the statement of financial position and the other figure will be recorded in the statement of profit or loss. So the statement of financial position will have the cost of investment. This cost of investment is actually the consideration. This consideration is similar to the consideration you have done for the subsidiary. It can be cash, it can be loan notes, it can be share exchange. This consideration is same as we have done for the subsidiary. Then you will be taking the share of post-acquisition profits. In the exam, the examiner is going to tell you that this is the profit of the associate. You need to see how many months fall in this year, and then you multiply it by the parent's percentage. So remember one thing, that you are supposed to calculate this figure if not given. So how you can calculate is the total profit of associate, and then you multiply it by months by 12 if it was a mid-year acquisition, and then you multiply it by the parent's percentage. It gives you, yeah, it gives you this associate thing. And this thing, this calculation I have done in the yesterday's lecture as well, which was the piquant question. You have to see that. Then you have the impairment if there's any. Then you have the unrealized profit. If parent is the seller, if there is dividend, then this figure will be recorded in the consolidated statement of financial position. Okay, in the income statement, there will be share of profit from associate, which you have calculated by the similar way, this one. And yes, then there will be the impairment, and this figure will be recorded in the income statement. The last thing in this consolidation is the disposal. Remember one thing, that if the parent is disposing a subsidiary in F7, you have the 100% disposal, although there can be many cases, but in F7 you have the 100% disposal. And the date of disposal is very important, because the date of disposal is the date on which the control is transferred, on which it does not actually be consolidated further. It should not be consolidated further. So until the date of disposal, the subsidiary should be consolidated. After the control is transferred, the subsidiary should not be consolidated. Then there is the third thing, which is the gain or loss. And this gain or loss will be recorded in the individual financial statement as well as the financial statements of the parent. Individual financial statements, sorry, of the parent and the consolidated financial statements. So individual financial statement, remember one thing, that the parent has disposed its subsidiary. The parent has disposed its subsidiary. So this subsidiary was actually presented as an investment in the parent's individual books. So this was an investment in the parent's individual book, and there was a carrying amount, obviously. This is the amount which has been received from the disposal of the subsidiary. So when you compare the amount which has been received to the parent by selling the subsidiary, and when you compare it by the carrying value of the investment, which is the value of the investment in the parent's individual books, it gives you the gain or loss, and it should be recorded in the parent individual financial statements. And then you have the gain or loss in consolidated financial statements. Gain or loss in the consolidated financial statements. So how this should be calculated? Gain or loss in the consolidated financial statements. So simply, first of all, you will be taking the consideration. And you add fair value of NCI. You add fair value of interest retained, although this fair value of interest retained is not the concept, although this fair value of the interest retained is not the concept in F7, but still fair value of the interest retained, fair value of the NCI, and the fair value of the interest retained. Okay, then you are going to less net asset at disposal and goodwill at disposal. So if you understand the mechanism of this working, so consideration, you add the fair value of the NCI, you add the fair value of the interest retained, which is probably not in F7, but still consideration, and you add the NCI, you less the net assets of the subsidiary at disposal, you less the goodwill value at the disposal, and when you compare this consideration plus NCI with the net assets and goodwill, it gives you the gain or loss, which should be recorded in the consolidated financial statements. Although I have shown this thing above in this calculation as well, but this calculation is a bit different, differently presented actually. You take the consideration, this one, and then you net off three things: net assets, goodwill, and NCI. Then you deduct this figure, it gives you the gain and loss. This is the same working, but I have presented in a different way. I have added consideration into NCI, and then I have deducted net assets at disposal and the goodwill. So this is, the consolidated income statement and the associate and the disposal. Okay, the next will be the question, but the question will be in the recording.